Good day, it's Liam here. Today we're going to be doing a quick video over CFDs, just discussing what they are and what the differences are between equity trading and CFD trading. Let's start going through here. I've prepared a couple of slides here. So firstly, contracts for difference, unlike equity, which you own, are still bank owned or institute owned, depending on where you trade. So you essentially are renting them. So you rent what are called contracts. So that's contract for difference. We'll get to the for difference part of that name in just a second, but you'll be trading contracts when you're doing CFD. So imagine I'm Standard Bank. Instead of you buying the shares outright from me, which is an option that Standard Bank obviously provides, you can rent them from me for a smaller input cost to start, which is the major benefit that we'll be discussing. So the way that this reduction in cost happens is by leverage, or sometimes called gearing. Especially Standard Bank uses the term gearing instead, but most commonly you'll hear it referred to as leverage. So the leverage ratio is usually between 1 and 1 and 1 to 10. So that's kind of the range that you'll be working in, but most commonly it'll be around somewhere 7 or 8. That's most common. So you might have Sibanye-Stillwater at a leverage of 6.8, and TCP might be at a leverage of 4.5. Different company might be 7.2. It really depends on share to share. Standard Bank determines these leverage values for you, and they present them on their site. So you'll be able to pull that up on any specific share as you're trading. Now, IG works a little bit differently. That's the other major platform that we use aside from Standard Bank. They don't work on a set leverage value. They instead focus on margin percentage. Margin percentage and leverage are similar concepts. A leverage value will tell you what fraction of the cost of the share are you paying. So a 5 leverage would mean that you're paying 1/5, whereas a margin percentage tells you what percentage you're going to be paying for that share. So a 20% margin is the same as a 5 leverage. But that margin that IG gives usually starts at 20%. And then it'll go up, the margin percentage will go up from 20% as you buy more. So your exposure might be at one value, and then that's a 5 leverage, and then if you buy more than that, if you buy, let's say, up to 75,000, let's say that might go down to a 4 leverage, going to a 35% margin fee. Now we'll go through an example a little bit later, so that these make a little bit more sense, especially the leverage, which can be a little bit of a tricky concept at first. But do just keep in mind that your leverage is going to vary from trade to trade. Now, your margin and bank margin. Your margin is what you pay, so that might be 1,000 Rand. And then the bank margin is the difference that the bank pays or helps you with, i.e. 4,000 Rand. Now this is how we usually like to explain it when we're just starting out, because it's simpler. But the way that this actually works is, once again, you're renting the shares from Standard Bank. So Standard Bank already owns the shares that you'll be working with. So you might want to rent 5,000 Rand worth of shares from them, and then they'll just ask you for a deposit, which is based off your margin percentage. So they might ask you for a deposit of 20%. So then you're paying 1,000 Rand, and then the other 4,000 Rand is essentially covered by them as they already own those shares. But we'll be talking about bank margin in just a second again, so keep that in mind. If your total exposure, the total value of the shares that you're going to be working with, is 5,000 Rand, you might be paying a margin of 1,000, and then the other 4,000 is covered by Standard Bank. Now, your exposure is what the shares would be worth after the transaction. You have an exposure value starting out as well, so that would be the value of the transaction for just the amount of shares that you're buying, so the value of those amount of shares. But then you also will have an exposure at the end of your trade, which the difference between the two exposures is going to account for the profits and or losses that you're making. Hence, once again, contract for difference. It's the difference in exposure between the opening and closing that you're going to be looking at. So let's say we buy an ABSA CFD. So CFD for share ABC, for 1 Rand each, with a gearing or leverage of 5, that gives you a percentage margin of 20%. So 5 leverage, 20% margin, meaning that for this R1 share, you're only paying 20 cents per share, or rather per contract. So let's say you buy R1,000 worth of those shares as CFDs. Because of the leverage, your R1,000 gets multiplied by 5. So you will have a R5,000 exposure, and then you'll be making profits or losses depending on that 5,000 exposure. Then you also have costs, of course. Standard Bank isn't going to do this for free, so they do charge you brokerage. Now this isn't that much. You'll usually be easily able to make up this amount. So for Standard Bank, they usually have a R50 transaction fee. And when I say usually, this is almost always going to be the case. So it's a R50 transaction fee on the buy and on the sell, and then you're paying value added tax on the transaction fee. So it's R57.50 on the buy and on the sell, totaling to about R115. IG works a little bit differently. They don't work on a brokerage system, they work on a spread system. This can be explained to you in more detail. If you ever do use IG, you can call in on the contact details that I'll provide at the end of this video. Or if you're busy with training with a technician, they can explain IG if that is what you're going to be using. But spread works not based off of a set value that they're charging you for the transaction, but off of a difference in the buying and selling prices. Lastly, you also have overnight charges. This is sometimes called swap. It varies from institute to institute, but can be anything from 48 cents upward. So for Standard Bank, usually you'll start from somewhere around 48 cents. It can be slightly less than this, but usually that's your starting position. And then the more you buy, the larger your trade, the more your swap will be per night. And this is for the total trade. So no matter how many shares you buy, it'll be that same amount just on the full trade every single night until you end up selling the share. Next, you can calculate some profit here. Let's say you open a trade with an exposure of R5,000, and then that share price goes up by 10%, so you make a 10% profit on the R5,000 exposure, meaning that you made R500 profit, equaling 55,000 total out. Sorry, 5,500 total out, excuse me. So that 5,500 in trade before the close, minus the R4,000 bank margin, so that amount that the bank was covering, you would be minusing that from the amount that you have left. So you would have 1,500 Rand total after the close. Minus the 1,000 Rand that you put in means that you made a 500 Rand profit total. But then, obviously, you have your transaction fees. More or less 100 Rand for Standard Bank in total, leaving you with 400 Rand profit, obviously then also taking off your overnight fees, which can vary obviously depending on the length of your trade. So this might be slightly less, but you should be making at least 350 or so Rand on this trade, maybe a little bit more, maybe a little bit less. It really depends on the exact specifics of when you bought, when you sold, how long you held. All of these factors will come into play as you're trading. Then CFDs can also be traded in both directions. So this is another major difference between equity trading and CFD trading. Obviously, if you were to buy a share, the only way for that share to make you money would be if the value of what you bought went up. But for CFDs, it's just purely about the difference in exposure. You can actually trade in one of two directions, either long or short. Now, keep in mind, this is not in reference to long-term and short-term. Everything for CFDs tends to be short-term. So the time frame won't be changing here. Long is in reference to trading in a bullish market, trading upwards and making money when the share grows. A short position is in reference to trading in a bearish market and thus making money as the share declines. So you can make money in both directions, and that is one major benefit of CFDs that we're also especially seeing now as the market is starting to shift in more of a downwards direction. Then another concept that we'll be working with a lot is a stop loss. Stop loss of between 5 to 7%. Most commonly we just set it at 5% to start, and then you can add some nuance there, add some analysis, maybe determine a different stop loss depending on the situation. But 5 is pretty standard. And this is done in a trailing stop loss. So a stop loss would generally be a price level where it's set that if the share goes lower than that price level, it'll automatically sell. A trailing stop loss, however, follows the price of your share upwards. So now let's say the share price goes up by 10% after you bought it and then drops 5% from there. This will obviously leave you with a 5% profit after the trailing stop loss is triggered. So this is one benefit there. It's basically a ratcheting system, basically just a safety net to catch you if you miss the share starting to decline. Although if you are trading ideally and you're doing everything correctly, you wouldn't be seeing your stop loss trigger. You would be using your analysis and looking at the share regularly enough that you would catch it before it hits that level. You'll also be working with a target, which you're not always able to set a target automatically for it to sell at, but your target usually is somewhere between 5 and 15%. So that's the amount of money that you'll be making on your exposure. So you can multiply this target value by your leverage to determine how much profit that's going to be in relation to your deposit amount. But once again, we'll go through an example of this in just a minute. Now, from there, we can go to this document, which is just a slide with an example of this trade. So there's some text at the top here. Both of these documents are available. If you want to receive these documents, you can always email in, and I'll give you the contact details once again at the end, and ask for these documents to be sent to you, and we'll send them out. But as an example, let's use INP. So INP is a company, Investec PLC. You'll be working with these codes a lot if you haven't been introduced to share codes yet. We have a couple of other webinars explaining some of the other topics on the software as well, but you're working with these 3-letter share codes. So INP here is what we're working with. And as an example, we're going to be putting 10,000 Rand into that share, into that trade. So on the one hand, we'll have an equity trade where everything is 1-to-1. The ratio is 1-to-1. You're paying full price for everything. And on the CFD side, your leverage is 1-to-5 for this example. So you're paying 20% of whatever anything costs for that trade. So the quantities are going to be different here. For your normal equity, if you were to put in 10,000 Rand, this share is worth 100 Rand per. So you'd be putting in 10,000 Rand to get 100 shares. Whereas if you were trading it on CFD, you're putting in 10,000 Rand, but now you're only paying 20% of the cost of a share. So you're only paying 20 Rand for each one of these shares. So now you can buy a lot more. You can buy 500 Rand, 500 shares, which totals to 50,000 Rand of exposure. So your exposure here on the equity side would be 10,000, and you're making money on the 10,000, whereas on the CFD side, your exposure is much larger, 50,000, so you'll be making profit on that. Talking about profit, let us suppose that the share does go into 10% profit, meaning that now the share price has risen to 110 Rand per share. So your quantities would still be the same, still 100 shares on equity, 500 shares on CFD. Your share price on both are the same, 110 Rand now. So now you sell the share for 110 Rand. 100 shares times 110 gives you 11,000 Rand exposure at the end for the equity side. 500 times 110 gives you 55,000 for the exposure at the end of your CFD trade. Your initial deposit on both sides was the same. But remember, on equity, you bought the shares with those 10,000 Rand. It wasn't actually just a deposit. You actually paid that money to, let's say, Standard Bank to actually buy those shares from them and own them. Whereas on the CFD side, that is just a deposit, and they have effectively been holding on to that deposit amount the entire time that you've been trading. So now, Standard Bank is going to give you back your 10,000 Rand deposit, but they want the 50,000 Rand that the shares were worth, they want that back at the end of their trade. So while you are left now with 55,000 Rand worth of shares, you actually owe Standard Bank 50,000. So you are only holding onto 5,000 Rand worth of profit. Getting your 10,000 Rand deposit back, you are left with a total amount of 15,000. So as you can see, the input cost for both of these trades are the same. The only thing that changed is the exposure amount, and thus the profits have increased as well. When you close the trade in this stage, you will have your initial deposit returned to you, as explained, and on top of that, you receive the 5,000 Rand price difference that came from your exposure. So that's what the difference is for. It's contract for difference, as in you're making or losing money based off the difference in your exposure. Then, with the same example, we can say instead of a 10% profit, we made a 10% loss, or the share went down by 10%, falling to 90 Rand per share. Still the same values here, 100 shares on the one side, 500 on the other. 90 Rand is now the current share price. So we can see our exposure on our equity side is now 9,000. Our initial deposit was 10,000, so we've made 1,000 Rand loss, but we're still left with 9,000. On the CFD side, though, we can see it was much worse, because now we are left with a 45,000 Rand exposure. So it's 500 shares times the 90 Rand gives you 45,000 Rand exposure, meaning that you've made a 5,000 Rand loss. So your deposit is still returned to you, but they're withholding 5,000 Rand from your deposit to get them to around 50,000, which once again is what you owe them. They gave you 50,000 Rand worth of shares, they expect 50,000 Rand back. So you're left with 5,000 Rand total still to trade with, but you can see that your hit was much larger here. We only lost 1,000 Rand on the equity side, but we lost half of our trade on the CFD side. As you can see, while the lower entry cost is a benefit, it can be a downside as well, as you can theoretically actually lose more than you put in to begin with. It's only in theory though, because with proper risk management, it's not going to really happen ever. We have 3 major lines of defense when it comes to that, which we, as I said, will discuss with you as we're doing your training. So if you're working with a technician via training, then they can explain these 3 strategies of risk management. But essentially, the first line of defense is going to be just looking at the share, just keeping an eye on it, making sure that nothing's going wrong, and that you are going to be making a profit, and selling when you see things go sideways. Second line of defense is that automatic stop loss that we referred to earlier, automatically selling your share once it has fallen 5%. The last line of defense is called a margin call. Now this is a little bit more of a complicated issue, but in short, just a simple explanation. When you get to a point where you're going to be losing more than you put in, let's say this share price now falls below 80 Rand a share. If the share were to fall below 80 Rand a share, you would be losing more than 10,000 Rand, and you only put in a 10,000 deposit to begin with. So losing more than your deposit is obviously something you don't want, but it's also not something that Standard Bank wants, because then you would owe them money on top of what you've already given them. They don't want this, so they will usually just end up closing your trade automatically once it gets to that level. So that's for a normal long position. As we said earlier though, you can trade in both directions. So you can actually make money as a share is falling on a short position. So we'll take the same example, 10,000 Rand worth of shares, or 10,000 deposit input at the start, for a short position still with 5 leverage. So now, everything on the left-hand side is still the same. Everything for equity is going to be the same as in the previous example. There's no changes there. But for the CFD side, it's quite different. You'll see 500 shares, 100 Rand each, but you're paying 20 Rand because you're paying 20%. So your deposit is still 10,000, your exposure is still 50,000. Now the way that this works on Standard Bank's end is essentially you're doing the trade in reverse, but we'll explain that as we're going along. So we can once again suppose a 10% growth, meaning that the share price rises to 110 Rand again. Now, 55,000 Rand is what your exposure is at the moment. But that actually means that you're losing the difference. So the difference between this exposure up here and this exposure down here is what you're losing, not making. So you lose 5,000 Rand there, you're left with 5,000. We'll see that is the same amount of loss as we had on a 10% downfall of the value of the share in the previous example. So instead of making a 10% profit from a 10% growth, you're making a 10% loss from a 10% growth. But this is the exact opposite when we go to the share falling. But let me explain a little bit more about how that is making you a loss when the share is growing. As you can see, we now have loss on the trade after a rise in share price. You can think of this as doing the trade in reverse, selling it first and then buying the share back later with the capital you gained from the sell. So you can think of it like when you started trading the shares, you immediately sold those shares for 50,000 Rand. So you got the 50,000 Rand from the outset, and then later you're coming and buying the shares back. You need to buy the same amount though, so we now had to buy it for 55,000, and that's how we lost 5,000. And now if the share falls, instead of a 10% profit, we have a 10% loss of value on the share price, dropping to 90 Rand per share. Quantity still stays the same. We now have an exposure of 45,000 Rand. So once again, with our previous example, we can say we sold it immediately got the 50,000 Rand there, and then we're paying back 45,000, giving us a 5,000 difference that we get to keep. Now, in our previous example, we said that we need to pay Standard Bank this 50,000 Rand back at the end of the trade. But what they will also accept is just the 500 shares that they gave you back. So the 500 shares is what you return to them at the end of the trade. So you sell the shares for 50,000, you get 50,000 there, you buy them back for 45,000 right there, leaving you with 5,000. You give Standard Bank the 500 shares that you just bought, you give them that back, they return your 10,000 deposit to you, and now you have 15,000. So this is essentially how that works. So this time we'll be making profit even with the share price falling. Once again, you can imagine that we sold the share initially, receiving 50,000 at the start of the trade, and now we buy back the same 500 shares for 5,000 Rand less than we sold them for initially. So that in essence is how CFDs versus equities works, and how leverage works as well. If you do have any questions, of course, always you can contact us. I'll quickly pop up those contact details for you here. So contact us on 012-9400-800, or you can use our 24/7 support numbers, those 3 cell phone numbers that you can see there. And also, as I said, email us. You can also email us if you want to receive these documents. We can send them out to you if you want to have a closer look at them. support@sharetracking.com or info@sharetracking.com. Okay, that's all from me for today. You all must have a lovely day further.